I wanted to start today with two pretty amazing experiences, because I, at the moment, in my day job, I have two renewals, one for a property policy and one for a liability policy, and it's interesting how starkly different um, companies, underwriters, engineers, and brokers approach the renewal process. For one of the policies, I received an email saying this is kind of the renewal document. Please review it, update the values if necessary, and sign it so we can renew. To which I said, hold on a second. Um, every renewal is an opportunity to make sure the risks are properly reflected. And it's more than just a formality of updating the values. If our risk profile changed, we have to capture that and we have to communicate that to the underwriter. To which I just said, I would like to have a proper meeting with the underwriter at some stage. But more importantly, I've asked the broker to prepare a list of key decision criteria, key points that the underwriters use for pricing, so we can actually um, update both the broker and the underwriter what's been happening in a year. So I want to take it much more seriously, even though it's not a particularly expensive policy. I do have some time. I'm not in the rush. We are starting the renewal many months in advance, so I want to do it properly. I want to understand what drives the decision making for that specific product, and I want to make sure I'm providing all of the relevant information to the underwriters to make the right decision. And also, every renewal is not an automatic renewal with the existing insurance company. It's a conversation with the markets to understand what is available in the market in general. So that was the first conversation. But the second one was, I think, even more interesting, because that was our major policy. And I had a meeting with the head of engineering and our main engineer and our main underwriter on that policy. And I thought kind of the original plan for the call was to just talk through the engineering recommendations and give an update on what's been happening. But as I started talking through that, what I realized is that a year is actually a very long time. So many things have changed, and we take it for granted, like we don't really think about that. But our company today, compared to our company a year ago, were significantly different. So many decisions have been made, so many things have changed in the market. Obviously, the war in the Middle East has a huge implications on the supply chains, on the demand for our product, on the pricing. Just a lot of the assumptions that we used to make for BI, a lot of the assumptions that we were making for the recovery timeframes, most of these assumptions have changed completely. So I went into the call expecting just kind of cycling through the recommendations, giving an update on what sort of engineering we're doing, what sort of budgeting we're doing, what has been completed, what is outstanding, just a very technical conversation. But what I realized is that in just a year, and technically speaking, it's even been less than a year, in 3 quarters, our business has changed so much that it deserves a full conversation with the underwriters explaining our technology again. We're investigating different alternative technological routes to improve recovery of the product. And while I take all of this for granted because I've been living through that, so to me it's obvious, like the risks are manageable, they're not significant. But when I just kind of in the passing mentioned that to the engineers, they kind of start making their own assumptions, saying, well, I've seen this technology being used elsewhere, and it was risky because it was different height, different reagents. Everything was completely different to what I have in my mind. But they already started making like all sorts of assumptions about the riskiness of the underlying process. And I just went like, oh wow, like it's such a nice wake up call. Going, oh, it's a full-time job explaining your risk profile to the underwriters, because nobody can read your mind. Nobody's really deep inside your technology and your location. Another fascinating thing is me as the head of risk, I've done like a deep dive investigation into how a climate change and specifically El Nino, La Nina will affect our specific mine site. And surprisingly, it actually looks like we would be revenue positive as a result of that. Like unless it goes like it reaches a certain threshold and it goes like super dramatic, we're actually net positive because we expect our mine site to have less rainy days over the coming decade, and dry days produce a lot more product and a lot more revenue than rainy days in Brazil in general. And all of this needs to be explained because people just are not aware until somebody tells them and kind of really built this narrative. I've also talked about the digital twin that we have, and I think that got people pretty excited because we we are now in the position to be able to simulate certain risk scenarios, and it's interesting to see how it kind of plays out compared to a usually quite a conservative estimates that the insurance underwriters are providing. So so many benefits in having those regular conversations with the underwriters and the engineers, and so much information that sits in the risk manager's mind that usually doesn't really make its way into the insurance conversation, and it costs real dollars. All of this silence is costing a lot of money. So Bernard, that was a long introduction by me. What's your experience? What are your thoughts on this?
No, it was some beautiful points that you directly mentioned. Like I think like there's two that I directly want to pick on and pick up, right? The first one you mentioned was more around like this context, this how do I normally describe it? Like this valley of depth of context, right? So you just like described like you as the risk manager, you obviously know the risk of your company best. You know the context. You day by day, right? Actually work on it, right? How is the underwriter supposed to know all of this? Like how can you actually like translate and share the right data, the right information, the right risk? And I would say like even like create an inception where you provide like your view that you have like to the underwriters that they can make the best judgment that they can do, right? Like the accurate one, right? I think that is so beautiful, like where we actually, and I think you're doing a great job like on really bringing over this context in a way to the underwriters, to the market, actually, that they actually grasp it and understand it, that they can actually price it more accurately and be nearer like to this actual risk profile and actually price in the end the risk profile. So I think this is this context piece where we want to really like get like as much and the right information actually to the underwriter that they actually can price the risk accurately. And I think like this is really like bringing over the context into the market through digital twins, through a risk digital twin that actually provides like the right data at the right time to actually have like the shared understanding of what the risk looks like. And then the second piece that I directly wanted to pick out there was super interesting what you just like shared of the mind that you guys have, right? Like in Brazil, like that, for example, a certain change to climate, like can on the one hand side, like be detrimental and can leave like actually you can have like a stranded asset, right? But again, it depends so heavily on what you have there. If it's a mine and if you actually benefit from dryness, right, and you can actually work longer and it's actually like better for business, right? This has to be somehow like you have to be able to assess that. It's a completely different thing if you like have a factory like where you produce like chocolate, right, and suddenly like the average temperature is like two degrees higher or whatever, and you just have to invest so much more in cooling. Actually, like in the transport doesn't really work anymore because your quality of product goes down, right? Because you cannot heat up the chocolate too much, right? Versus like having the mine, right? Like where and this may be some crazy opposite examples, but it's just like how I think about it. Like we actually have to put the risk into context, and there's a huge difference now. Is it more drier? Hey, that's actually good for business versus it's drier and I'm not gonna have like enough water for my crop, or I don't have enough water to actually produce my bottled drink. Like if I'm Coca-Cola or something like that, I need water to actually like produce my product. So if this actually leads to a certain dryness and scarcity, then there's a problem. And this is like this beautiful thing of contextualizing the risk and really like bringing it down to what does that mean for you, for your business model specifically. And then the other part, like actually bringing this into the market, the right accurate picture as you see it, helping like you actually helping the underwriters and these other people to understand you better. And this is also like how I see the industry working better, creating this transparency on the risk.